I need you to stop whatever you're doing right now and listen to what I'm about to tell you, because something absolutely unprecedented just happened at the United States Mint that changes everything. At 11:47 a.m. Eastern Time today, Tuesday, April 7th, 2026, the U.S. Mint officially suspended all new orders for American Silver Eagles until further notice. Not delayed shipping, not limited quantities, completely suspended. And buried in their official statement was a phrase I have never seen the Mint use in my entire career tracking precious metals: acute supply constraints of sufficient severity to constitute a national concern. Let me translate that government speak for you. The United States Mint is publicly admitting they cannot get enough silver to produce America's official silver coin. The same mint that has operated continuously since 1792. The same mint that produced silver coins through the Civil War, 2 World Wars, the Great Depression, and every crisis in between. That mint just told the American public they're out of silver. And while that news is starting to trickle through precious metals communities right now, what nobody is reporting yet is why this happened, when the crisis actually started, and what it means for the price of silver you're seeing on your screen, $72.98 per ounce, which is about to become completely disconnected from physical reality. Let me take you inside the supply chain collapse that just forced the U.S. Mint to declare a national silver emergency. The Mint doesn't mine silver, they don't refine it. They buy silver blanks, pre-made circular discs ready for stamping, from a handful of authorized suppliers. For decades, their primary suppliers have been Sunshine Minting in Idaho, and several facilities that source refined silver from international markets, particularly from Asia and South America. Here's what happened in the last 90 days that broke the system. On January 1st, China implemented strategic export controls on refined silver. That immediately cut off 60-70% of global refined supply from international markets. The Mint's Asian suppliers couldn't get metal. On February 15th, Peru, the world's second largest silver mining country, experienced severe flooding in the Arequipa region that shut down 3 major mining operations. Production dropped by 180,000 ounces per week. That's 720,000 ounces per month that simply vanished from global supply. On March 8th, Fresnillo plc, operating the world's largest primary silver mine in Mexico, announced they're cutting 2026 production by 9% due to declining ore grades and rising operational costs. That's another 2.1 million ounces off the market this year. And then last week, something happened that I believe was the final trigger. The Indian government, facing a currency crisis as the rupee hit all-time lows of 91.7 to the dollar, quietly told their largest silver refineries to prioritize domestic supply. India is the world's largest consumer of physical silver. When they start hoarding domestically, there's nothing left for export. The U.S. Mint's suppliers started calling them 3 weeks ago saying, "We can't fulfill your orders. We don't have the blanks. We can't source the refined silver." The Mint tried to find alternative suppliers. They contacted every refinery in North America. They reached out to European sources. Nobody had available capacity. And today, April 7th, 2026, they ran out of options and had to make the announcement. Now, here's what makes this absolutely terrifying. The U.S. Mint's silver consumption is tiny compared to total industrial demand. They use approximately 35-40 million ounces per year for all their silver coin programs combined. That's less than 5% of total global silver demand. If a purchaser using just 5% of global supply can't get metal, what does that tell you about the actual state of the physical market? It tells you that the supply crisis is so severe that even official government institutions with privileged access to refineries and priority purchasing agreements are being rationed out. Let me show you the data that proves this isn't just a Mint problem. This is a total system breakdown. According to the most recent Silver Institute data released this week, the global silver market is now in its 6th consecutive year of structural deficit. Total cumulative deficit since 2021, 823 million ounces. That's more than the entire annual mine production of the world's top 3 silver-producing countries combined. COMEX registered inventories, the actual physical metal available for delivery against futures contracts, fell to 84.7 million ounces as of yesterday's report. That's down from 286 million ounces in January 2020. The coverage ratio is now 13.8%, meaning there are 7.2 paper claims for every real ounce in the vault. But here's the number that should make your blood run cold. Total identified above-ground silver bullion inventories globally are estimated at approximately 2.7 billion ounces. That sounds like a lot until you realize that annual industrial consumption alone is 550 million ounces and growing at 6 to 8% per year. At current consumption rates, without any increase in investment demand, the world has less than 5 years of above-ground silver inventory remaining. And we just lost access to 60-70% of refining capacity from China. And Peru's production is down, and Mexico's largest mine is cutting output, and now the U.S. Mint can't get supply. Do you understand what's happening? We're not approaching a supply crisis. We're already in one. The Mint's announcement today is just the first official admission. Now, let's talk about what this means for price, because this is where it gets really interesting. Right now, silver spot price is $72.98. That's down 40% from the January all-time high of $121.64. Every mainstream analyst is telling you the silver rally is over, the correction is healthy, maybe it goes back to $60 or $50, but those analysts are looking at paper price on the COMEX. They're not looking at physical premiums. And physical premiums are about to go absolutely parabolic. Let me give you real numbers from dealers right now, today, April 7th. SD bullion. Generic silver rounds, when available, are $6.50 over spot. American Silver Eagles, the few they have left, are $14.50 over spot. That's an $87.48 real price for an eagle when spot is $72.98. JM Bullion. Their website shows limited quantities on almost every product. Buffalo rounds are $7.25 over spot. Maples are $9.50 over. And this is before the Mint announcement goes mainstream. APMX. I checked at 2 p.m. Eastern today. Their inventory of Silver Eagles has a yellow low stock warning on 2024 and 2025 dates. 2026. Silver Eagles, completely unavailable because the Mint isn't producing them anymore. Local coin shops in major cities are reporting premiums of $8, $12 over spot for generic rounds and $15, $20 over for government coins. And that was yesterday. By tomorrow, after the Mint news circulates, those premiums are going to be $15 base and $25, $30 for Eagles. Do you see the divergence forming? Paper silver on the COMEX is $72.98. Physical silver you can actually hold in your hand is already $85, $90 and climbing. That spread is about to explode. Here's why. The U.S. Mint suspension sends a signal to every investor, every stacker, every person who is thinking about buying silver. If the United States government can't get silver, I better get mine right now before it's completely unavailable. That creates panic buying. And panic buying in a market that's already experiencing the 6th year of deficit and COMEX inventory depletion and Chinese export restrictions creates a demand surge that the supply chain absolutely cannot handle. The major online dealers source their inventory from the same refineries that supply the Mint. If those refineries can't produce enough blanks for the Mint, where exactly do you think APMX and SD Bullion are going to get their inventory next month? They're not. The pipeline is dry. And once current dealer inventories sell out over the next 7 to 14 days, there's nothing coming to replace it. That's when you're going to see premiums that make today's $6.08 over spot look like a clearance sale. I'm talking $20, $30, maybe $50 over spot for basic rounds. Government coins, they'll command whatever premium the market will bear because there's no supply and unlimited demand. And here's the critical point everyone is missing. This premium explosion happens while the paper spot price could still be falling or moving sideways. The COMEX price is set by futures contracts, traded by banks and hedge funds who never touch physical metal. The physical market is set by real supply and demand for actual ounces. Those two markets are about to completely decouple. You could see spot silver at $70 on the COMEX, while physical rounds are selling for $120 at dealers. That's not speculation. That's exactly what happened in March 2020 when premium spiked to $12.15 over spot, while paper price was $12. Real silver was trading at $24.27, while the official price was $12. We're about to see that happen again, but on a much larger scale, because the supply situation today is far worse than 2020. Let me give you the second order effects that almost nobody is considering yet. When the U.S. Mint suspends Silver Eagle production, that creates immediate downstream panic in the numismatic and collectibles market. Limited edition sets, proof coins, special releases, all of that is now frozen. Dealers who base their entire business model on Mint products have nothing to sell. So what do? They start buying back silver from customers at higher premiums to create inventory. That puts upward pressure on the secondary market. Stackers who were thinking about selling see rising buy prices and decide to hold instead. That reduces supply even further. Meanwhile, every pension fund, family office, and high net worth individual who has been reading about de-dollarization and BRICS currency initiatives and Federal Reserve emergency liquidity measures sees the Mint announcement and thinks, if the government can't get silver, maybe I should own some. Institutional buying enters the market, and institutions don't buy 10 ounces. They buy 10,000 ounces. They call the big dealers and say, I need 500 kilos delivered next week. And the dealers have to tell them, we can't do that, we don't have it. That's when institutions start offering premiums directly to refineries, and they bypass the dealer network entirely and go straight to the source. And refineries, seeing multiple buyers competing for limited output, start raising prices. This is a doom loop. Decreased supply, increased demand, rising premiums, panic buying, institutional entry, refinery rationing, more panic, higher premiums. It feeds on itself until either supply dramatically increases, which can't happen because mines take 10-15 years to develop, or demand gets destroyed by prices so high that marginal buyers are forced out. But here's the problem. Industrial demand for silver is completely inelastic. Solar panel manufacturers need silver, EV producers need silver, AI data centers need silver. Those buyers don't have a choice. They pay whatever it costs, or they shut down production lines. At current consumption rates, the solar industry alone uses 130 million ounces per year. That's 3 times the US Mint's annual consumption. And solar production is growing 20% per year. EV manufacturers use 100 grams per vehicle. With 15 million EVs being produced in 2026, that's 75 million ounces. And EV production is growing 30% annually. You've got non-negotiable industrial demand of 550 plus million ounces, competing with investment demand and jewelry demand for a supply base that can't grow and is actually shrinking due to Chinese export controls and mine production cuts. The mint suspension is the canary in the coal mine. It's the first visible crack in a system that's been under stress for 6 years. And once the crack appears, the whole structure fails very quickly. Let me show you what the smart money is doing right now. Bloomberg reported this morning that hedge fund silver holdings tracked through exchange-traded products rose by 1,847 tons in March, the largest monthly increase since January. That's 59.4 million ounces of institutional accumulation in 1 month. These are not retail stackers buying 5 ounces at a time. These are billion-dollar funds taking massive positions. The most recent data from India shows silver imports in January-February 2026 reached 206.76 tons, the highest level in 8 years. India is vacuuming up physical supply at the exact moment global production is constrained. And then there's the LBMA data. Total silver held in London vaults fell by 237 tons in February alone. That's 7.6 million ounces withdrawn from the system in 1 month. Where did it go? Private hands, people who are taking delivery and storing outside the banking system. The data is screaming one message. Informed buyers are accumulating physical silver as fast as they can source it, regardless of price. Now, let me address the question. I know a lot of people are asking, is this mint suspension temporary? Will they restart production in a few weeks once they secure new supply? Here's my assessment. The mint will absolutely try to restart production. They'll offer higher prices to refineries, they'll negotiate priority agreements, they'll try to source blanks from European facilities, but the fundamental problem doesn't go away. China isn't reversing their export controls. Those are strategic and permanent. Peru's flooding damage takes months to repair, and even then, production won't immediately return to previous levels. Mexico's ore grade decline is geological. You can't fix that with money or time. India's domestic hoarding is driven by currency crisis, and that's not resolving anytime soon. The supply conditions that force the mint to suspend production are structural, not temporary. Best case scenario, they manage to restart limited production in 6 to 8 weeks at significantly reduced volume. Worst case, the suspension extends for months. Either way, Silver Eagle availability is going to be severely constrained for the rest of 2026. And that creates a collectability premium on top of the already spiking physical premium. 2026 dated Silver Eagles could become the most valuable modern bullion coin in history, simply because mintage numbers will be a fraction of normal years. Numismatic value on top of metal value, on top of scarcity premium, you could see 2026 Eagles trading at $150, $200 each, while spot is still under $100. Here's what I'm doing personally, and you can make your own decisions based on your situation. I'm buying every ounce of physical silver I can afford right now, today, before the mint news goes fully mainstream. I don't care about premiums. I don't care if spot drops to $65 tomorrow, because I understand that physical availability is more important than paper price when the supply chain is breaking. I'm focusing on weight, not product type. Generic rounds, government coins, even junk silver bags, anything I can get delivered in the next 7 to 10 days before dealer inventories are completely wiped out. I'm calling dealers directly instead of just ordering online because phone orders often get access to inventory that hasn't been listed on websites yet. I'm asking specifically about delivery times and confirming they have metal in their domestic warehouse, not on back order from overseas. And I'm documenting everything, order dates, premiums paid, delivery times. Because I think 6 months from now, we're going to look back at April 2026 as the last moment you could buy physical silver at anything close to reasonable premiums before the market went completely vertical. Let me give you the timeline I'm watching. Today, April 7th, mint suspension announced, limited immediate market reaction because most people don't understand the implications yet. April 8th, 10th, news spreads through precious metals communities. Dealer websites start showing out of stock on popular products. Premiums start rising. April 11th, 14th, mainstream financial media picks up the story. CNBC runs segments on the mint suspension. General public starts panic buying. Dealer inventories collapse. April 15th, 20th. Major dealers announce they're temporarily suspending new orders because they can't source inventory. Secondary market premiums spiked to $15.25 over spot for generic rounds. Late April. First institutional buyers get locked out of the physical market entirely. Paper price and physical price fully decouple. COMEX silver might be $70, but you can't buy a real ounce for less than $100 anywhere. May 2026, congressional hearings about the mint suspension. Politicians demand answers. The mint testifies that global supply chains are broken and there's no short-term solution. Market panic intensifies. This is my forecast based on current data and historical precedent from previous supply shocks. I could be wrong about timing. It might happen faster or slower, but the direction is clear. The United States Mint just confirmed what independent analysts have been warning about for months. The physical silver market is in crisis. Supply cannot meet demand. Inventories are being drained. And the institutions with the most privileged access to supply are being rationed. If you're waiting for lower prices, if you're trying to time the perfect entry, if you're hesitating because premiums are higher than you want to pay, I need you to understand something. In a supply crisis, availability matters more than price. You can't buy silver at $50 per ounce if there's no silver available at any price. And we are rapidly approaching that scenario. Silver spot is $72.98 today, April 7th, 2026. MCX silver in India is Rs2 and weigh 894 per kilogram. The U.S. Mint just declared a national supply emergency. COMEX inventories are at 84.7 million ounces with 7.2 paper claims per real ounce. China controls 60-70% of refining and has locked exports. Industrial demand is 550 million ounces annually and growing. This is not a drill. This is not hype. This is the U.S. government officially confirming the supply chain is broken. The analysts saying $125, $175, $500 silver. They're not crazy. They're looking at the same supply and demand data I'm showing you and doing basic mathematics. When demand exceeds supply for 6 consecutive years and the world's official mint can't source metal, there's only one possible outcome. Price goes vertical until demand is destroyed. And with industrial demand being inelastic, that means price has to rise far enough to eliminate investment demand entirely. How high is that? Nobody knows. But it's a lot higher than $72.98. This is the Hidden AG, April 7th, 2026. The emergency is official. The window is closing. Secure your ounces while they still exist.